Hello everyone, I'm Mike Connors, and welcome to How It Ticks, the go-to podcast for anyone with a spark of curiosity about the inner workings of Switzerland. Hosted by yours truly, an Australian expat with a deep curiosity, How It Ticks offers a platform where listeners are invited to explore the vast landscape of Swiss culture, business, innovation, and tradition. Each episode features a one-on-one interview with experts and thought leaders from various fields, providing a panoramic view of what makes Switzerland tick. If you are like me and you enjoy listening to successful people share their insights, this podcast is for you. In this episode, I sat down with Philipp Flesch, an investment associate at Nordic Eye Venture Capital, to explore the world of venture capital and startup investment in Switzerland. Philipp shared his insights on the process of identifying and choosing startups to invest in, revealing what qualities make a startup stand out, and the red flags that can turn investors away. We discussed the different stages of funding, when to double down and invest more, and when it might be time to exit. Philipp spoke about the challenges of navigating a failing startup and how venture capitalists decide whether to step in and assist or cut their losses. We also spoke about current market trends and how to separate startups which are using these trends in innovative ways from the ones riding the hype wave. I hope you enjoy this conversation. Philipp, thank you so much for joining me today. How are you?
I'm good. Thank you so much, Mike, for having me on the podcast.
I thought a good place to start would be, what does a person working for a venture capital firm actually do every day? To me, it seems like a bit of a mystery.
Okay, that's a good start. So basically, as a team member of a venture fund, it depends a bit on your seniority or experience levels, but in the overall and the bigger picture, basically it involves sourcing good opportunities, meaning you need to look for good startups, wherever that is. Usually funds have a geographical focus, so you go and hunt for the right startups in your territory, or you look abroad through your network, however you get access to these deals. But quite some time is spent on basically sourcing the right opportunities and getting also to know the right people, i.e. networking, getting to know other funds, getting to know the founders, knowing where startups are created, etc. And then after that part, a lot of time is spent on the due diligence. So that means you get to know the team, you get to know the company, you get to know the business model and all the different factors that we're probably going to speak afterwards as well. And you assess the business, you do your due diligence, which consumes quite a lot of time. Some funds spend less time on it because just there is not so much to assess. So a pre-seed or seed venture fund a person at a pre-seed or seed venture fund would spend less time in that because there's just not so much things you can actually assess. At later stages, there's more material and more information to digest and then also to assess. So you spend more time on that, and the deal structures become more complex. And so after the sourcing and the evaluation part, you negotiate usually with the founders the terms of the investment round. That can be the valuation of the business, that can be any kind of preferential shares, that can be any additional terms that you want to include into your investment. And you execute the deal. So you sign the term sheet, you sign the subscription agreements, the shareholder agreements, and after all the entire analysis and transactions is done, you also of course spend time on monitoring the business. So that is often what people forget. But you spend, let's say an investment assessment takes 3, 4, 5 months. That is fairly quick if you compare it to the lifetime of what you spend with the company overall in the fund. So the real work starts, as we usually say, the real work starts at once the investment is done, and that includes monitoring the business. So not only monitoring, it depends a bit on the activeness of an investor at the business. For our fund, we've always been quite proactive. We also have usually board seats, so we are very close to the business. Other funds are a bit more distant because just of the investment style that they have. But when you're closer to the business, you have quarterly meetings, regular touch points with the team, with the founders, to really make sure that the business is is going the right way, and also to help, of course, the team and the founders to execute on their strategy and the investment plan that you have subscribed to.
Within your territory where you go and look for potential new startups, what sort of events or what sort of environments do you actually find them and meet them?
So that can be actually anywhere. It starts from very easy conversations where you even you have friends of friends saying, that person starting a business. Do you want to talk to them? They're looking for funding, so it can easily start from these kind of conversations. But more, let's say, more systematically speaking, well, you can find startups at networking events. So there's every year there's in different locations there's events for startups and investors to meet. There's in Lisbon there's the Web Summit. You have in Zurich you have several events happening, startup days. You have Noah. So there's events is basically a good place where you can always connect to startups, where they're actually made exactly for that. So you have startups coming to these events to present themselves. They have stands. They speak on certain topics, and then investors come and could meet them for networking, etc. So that is one way. The other way is that you go, basically you connect to your local fund network of other venture funds. So for instance, if I take our fund as an example, we are a Series A investor. So what we often do is we connect with funds that are either at the same stage where we invest or at an earliest fund stage they invest. And whenever portfolio companies are at the next funding stage and the next funding round, let's say Series A, we would try to connect to them and be in touch with them, because that already gives us a good insight, right? If the other fund has looked at it and they say these guys are doing good, they're looking for a next funding round to continue their growth projections, etc. That is a very good indicator if you have a strong opinion about that fund as well. So these are different ways to meet the startups. A lot is more local, like through networks, through these events, through contacts. In Zurich, for instance, I think also hubs around the universities, especially on the technical side. So ETH in Switzerland here has very strong founders or potential people in the technology space that are building businesses. So there's a lot of talent coming out of that, a lot of ideas coming out of the universities. Also at EPFL in Lausanne. So there's also sources like that where you can connect, and there's always events happening, which are actually targeted towards bringing investors, individual investors, so can also be angel investors, but also fund investors, i.e. more institutional investors, to these universities in order to meet the founders and connect those two sides.
How do you assess and choose a startup? You must go through so many of them, from the events, from your Uncle George to everybody suggesting that you should put money somewhere. What is your evaluation process?
So I think the important part is to know at what stage you invest. For me, I think it's very important, because a lot of people might think, venture capital is just one big, it's all of the same, but it is actually not. So because the stages of the business are so different. So it's different if you and I would just start a business and we would look for the first money, to get off the ground, to set the company up, to have, the first IT systems in place, accounting, legal stuff. It's very different to a business that has already, let's say at the Series A stage, has a product that is ready, customers that are paying, entries into different markets already, different customer segments. So the way you assess or what you look for in a business is very different. And so I think, but what it all comes down to, if you would have to see it from a general perspective, is the number one criterion. I think everybody knows that is the team is what makes or breaks the business. There's always the saying, and I've heard it millions of times, and probably some of the listeners have also heard it a million times, is that a good idea will break with a bad team, but let's say a rather bad idea or not such a good idea will make it with a very good team. So this is the team is, and if you think about it, after all, is like if you and I would start a business, the first thing that people will look is like, who are these guys? What have they done? What makes them succeed in this space? So these are exactly the questions that, an investor, whoever trusts or puts money into the business, is at the end putting money into you or into the team that is behind it. So team is number one criteria and number one important factor that investors look at. And then if you're a bit on the earlier stage, people also look at, of course, what is sort of the market size? Like, what market are you trying to, let's say, attack or want to succeed in? And that is important because, there are some markets that people think of, they're very growing, they're upcoming. There's markets that are more established, more known, more information is available. So people try to assess what is exactly that your product or your service is trying to solve, which problem are you solving in that industry, in that specific industry. And that is, of course, very important. So I don't know if there's a business in the electric vehicle space, that is just a market that is upcoming. But if you're a business that is trying to do, I don't know, IT systems, I don't know, like legacy systems, like nobody will, everybody's like looking, why do you think you can now tap into a market that is very crowded? There's a lot of players. There's a lot of like strong players that can easily, do what you're doing. So it's a lot about the market as well. And then I think those are the two main things when you look at the early stage. Then if the company grows a bit further in the stages, I think what comes to it is then, of course, also, everything on the growth and the revenue side. So that means, how strong are your sales capabilities? Do you have a sales team in place? How strong is the product? Does the product need more additions? How mature is it? Are customers asking for it? And how much can you really, grow into either different customer segments or into different geographies? Like, because let's say you have captured a large portion of the Swiss market. Are you able to do the same in another market? So you're trying to assess how, like, and that is a bit more where we, or the fund I'm working for is where we're basically looking at is the money that we invest, where will it go? And in an ideal scenario, we would like to have the money invested into either growing into another geography, extending the product offering or service offering that you have, increasing the sales organization. It's these kind of verticals, I would say, that we would like the investment that the companies or the funds that the company is raising in the respective rounds will be used for.
How about time? How does that fit into it? So I can imagine if a startup is very promising in terms of a product, it is growing, but say, for example, they're not ready to expand from Switzerland to other countries. They will, but in a longer period of time. How much pressure would you apply in terms of the amount of time they have to sort of hit the metrics that you want them to hit?
Yeah, that is a very good question, because after all, the fund is, of course, interested. Usually funds have a lifetime of 10 years. There's an investment period of, let's say, 3 to 5 years, depending on the funds. And then you have a time, where the money works, and then you need to exit the investment. Mm-hmm. So time is definitely a critical factor. And I think there's also, it always depends a bit, but there's some funds that even would anchor their investment or the funds that they will release until certain milestones are reached. That is what some funds do at an early stage. So let's say someone commits to invest, let's say 1 million. And then he would say, if you reach that milestone, you will get the first 250. If you reach that milestone, you get the next 250. So, some funds have actually exactly that timeline in mind, also to de-risk their investment, of course, but also to make the team work towards certain timelines, so they know that the capital is effectively and efficiently deployed for the right things, and the company is actually moving forward. Because of an early investor, an early stage fund, their goal is that the company will reach a stage where they can go to let's say a Series A or a Series B investor to get the next funding in.
So can you just quickly explain what the Series A, B, C stages are? Maybe that's a good idea.
Of course, 100%. So usually when we talk about financing rounds and funding rounds, there's different stages or different rounds that startups complete. The earliest that you would probably find as an official round, like usually companies start, it always depends a bit, but let's assume that companies start with a business angel, friends and family investment. So that could be our families, that could be friends around us that have some money that would invest 10K, 20K, 50K, depending on their availabilities. Then the first, let's say, and that is probably considered pre-seed. So that would be sort of the first, if you want to label it, the first official round. The pre-seed is then followed by a seed round, and the seed round is often where you have, or where you could have first, let's say, a bit more institutional venture funds investing. It can still be money could still be invested from business angels, from friends and families, but you would often see the first funds to come in at the seed stage. The seed stage is then followed by a Series A, and from there it goes on Series A, B, C, D, E, and there's in practice there's no limit to it. But what basically happens is these funding rounds just have labels, so people know approximately where you are in terms of your funding in terms of your funding stage. And maybe I can share a quick anecdote there, because when I was working at the bank in London, so the bank usually works with startups at the later stage, usually in the pre-IPO phase, and then of course on the IPO, so on the listing of the business. At that time, and at that point in time, there was actually so much funds or private money and private equity available. So in private markets, so startups could actually stay private for longer. So there was a huge trend in private markets. That meant that in that times there was so much capital available. So what happened is that startups didn't actually want to go for a listing at the stock exchange to raise more money, but they could just extend their round. So we actually went down to Series F, G, H, rounds that nobody has seen before.
Why would you do that? I would imagine, most people working for a startup would want the IPO, right? They want to get paid out. They want to finally cash in all of the work. What would be an incentive to push this privatization for longer?
You could still sell your stake in a private round, right? It doesn't have to be through a public listing. So that is not the incentive. The real incentive was just that to keep doing private rounds continuously, was that just the effort and the cost and everything that is attached to a public listing is so much bigger than just keeping on with private rounds. Because if you want to list your company at the stock exchange, it usually requires an investment bank that helps you. It requires a ton of operational work to get prepared, a lot of fees for lawyers and for the bankers, etc. So it's not an attractive, of course it is all possible, but it takes a lot of time, it costs a lot of money, and it's a lot of distraction from the core business. So that's why people always prefer to keep these private rounds going.
What are some real red flags or cautionary signs when it comes to looking at different startups of potential opportunities? Which ones do you go, what? Yeah. I'm staying away from that. This is why.
Yeah. But there is, so you need to separate that, because there's two options, I would say. One, which is, because you can imagine you don't only get high quality deal flow, right? It's not like you get every opportunity that you get introduced to, or that you find, or that you are sent or shared or whatever, is I definitely want to look closer into this. There's also a lot of companies that just from the first read, usually you get a blurb or a short summary or a pitch deck or a short teaser, whatever it is. A lot of them, immediately if it's in or out. So that's not immediately a red flag, but I'm mentioning this because there's a lot of pitch decks that you get shared where you say, no, this is just not, it just doesn't look professional. It's very basic things, the pitch deck just looks all over the place. There's mistakes in it. There's weird numbers in it. So it's just a very obvious red flag where you just, you prefer to just, say thank you, but no thank you. But I think a real red flag, once you have a deal and you look a bit closer into it, is a lot around if some things don't add up. So that starts, for me, it starts with the numbers. So a lot of revenue projections or customer projections that are unrealistic, or that are obviously unrealistic. That there's with the time, it's all an experience question, because over time you get a sense of what is really feasible, what is not feasible, what can be achieved, what cannot be achieved. So I think a big red flag is for me if there's completely growth numbers that are not whatsoever. Even let's assume I don't know the industry at all, I don't know the team, I don't know the customers exactly. But if you just look at the numbers and someone tells you that every year they triple or quadruple or whatever, sixfold their revenues every year, then it just doesn't sum up. And believe me, it sounds very simple and very straightforward what I'm saying, but you still see these kind of projections in pitch decks. When I joined this investment discipline, there was only one way these financing rounds and the valuation went, and that was to the right and up, basically. So there was no investment round that was big enough. There was no valuation that was high enough. And there, in these times when I joined, you would see these kind of projections, and that is, of course, at the end, it's all feasible, right? Our founders would argue, if I have enough money, I can pull this growth off, because I can hire more people, I can spend more marketing, I can increase my, I can open an office in Germany and Austria, and I don't know, the US even, make it, reach the big market. So it's just a question of funding at the end. So these were always the justifications that you were provided with. But after all, and that is why, the last year or two was a very different market environment in the venture space. It was actually quite the opposite. And after all, even though it is hard, and it's still hard for funds to raise money, to, etc., it is a very important reduction, I would say, of the or let's say a healthy recovery of the market, and for startups. So you won't see these inflated and projections and numbers anymore. So that is I went a bit around, but that is a big red flag for me. And also the dynamics around the team, have there been changes? And it's fine to have changes, but you need to understand why has the change happened. Like, why is this founder, why has he left the business? Why is this, I don't know, important management person not there anymore? So it's a lot about these kind of things on team composition, but also on historical funding, where I would look for red flags, and that I would basically try to understand.
You also said that you are industry agnostic when looking for opportunities. In saying that, are there any industries that you tend to stay away from?
Yeah, so there's industry you want to stay away from because you just don't want to invest in them, just from let's say an ethical motivation or cultural or whatever motivation avoids you from investing in that space. And then there's, of course, industries that you just don't feel comfortable investing in, because it is important to understand that once you invest into a business, and given that we for instance, and many other funds are agnostics, i.e. that means you would invest in any kind of sector without special expertise. Let's say in our case, biotech, anything related to pharma or medtech. Just industries, I would classify industries that you don't feel comfortable or you don't really understand. Because at the end, I think, again, it depends on the VC fund, but I think if you're close to investment, you really want to add value to the business, right? That is always the difference between, let's say, money and smart money. And what you want to be is you want to be smart money. So that means that you would like to help the founders open up your network. That is often the most common support that funds bring to the startups. But you want to help in any kind of form. If it's on connecting to customers, if it's on bringing your expertise, how to build up a sales organization, if it's about your knowledge on how to price your product or your services right in different markets, like you want to add to the business. So you need to be very close. That means that if you don't understand, or if you don't have a network, or if you don't have any experience in a sector, you would naturally just try to avoid it and not invest.
When you say that you want to help, does that mean you position yourself with decision-making power with these startups? Or what do you mean by help?
Yeah, that's a good question. So, and that always, lies in the interpretation of it. But I think if you are let's say an active investor, an active venture fund, could also be a private equity fund, of course, but let's say in the venture space, an active venture fund, you want to help, never really on an operational level, i.e. saying to the founder, do this or do that, but rather be a sparring partner to them. So you want to advise them, you want to share your experience, because often, let's say in our fund, if some of the partners sat on the board of the investment that we did, of the company, they usually have gone through similar experiences. They have done, they have built up startups, they have bought companies, acquired companies, restructured and turned around businesses, sold them again. So there's just, with the investment, there's someone behind that has, let's say, a bit of gray hair and a bit of experience, that you can share with the founder, and it's at the end helping him avoid some mistakes, because often in building a business, it's often how, like, can you avoid some mistakes that might cost you a lot, or that could cost you a lot, and cost could mean money, could mean time, could mean people, whatever the cost is, but that's what you're trying to avoid. So you want to help them, in the sense to be a sparring partner, discuss with them, spare with them ideas, bring them onto something, connect, of course. Like if you have a network, let's say, what often, in our phase, what we try to do is we try to work with the businesses and then connect them with other funds in the next funding round. So we could help the founder in the sense of helping him securing the next funding round whenever it comes to it. So these are kind of the some of the tasks, or some of examples of tasks that you would be able to help the founder with, in this journey of building up a business.
What would your success rate? Two questions. How do you measure success when it comes to your investments, and what would your typical success rate be?
Okay, so here again, it depends a bit on the stage. If you are a early investor, let's say a pre-seed or a seed investor, your risk is much higher than, for instance, at the Series A or B stage, or at a later stage as well. So, and you will get compensated for it, right? Like, the more risk you take, the higher the reward would potentially be. But I think at an early stage, you would say, and I think this is very fairly known as well in the venture space, is that you would say of 2 startups, of 10 out of a portfolio of 10 startups, you would assess, or you would say that 2 startups, or 1 or 2 startups, will really generate like big returns, and almost, we call them home runs, if they really return the fund. You might have, let's say, 4 startups that are somewhat in the medium space. So that means either they return some money, a bit less than a bit less of what the invested capital was, and then you have probably 4 to 5 startups that are just that you need to write off, because the team has made it, they haven't achieved the goals that they wanted to, they didn't get the following funding round, etc. So that is usually what you see in an early stage as a success rate. In the Series A phase, where we usually invest, this success rate needs to be a bit improved, right? Because we also take less risk, like slightly less risk. We get also slightly less reward in theory. But in our part, it should be a bit, the ratio should a bit change. It should be a bit changed, right? We should have probably much less write-offs. So maybe, let's say 2 or 3. We should have, probably 3 or 4 companies, let's say 2 or 3 companies that are somewhat with a reasonable return. And, the remainder, so another 4 or 5 businesses are somewhat in the middle range. But that is how you would probably think about it, and what an investor into a venture fund would expect in terms of success rate, in terms of return expectations.
How do you do evaluation? So I hear often you go on SwissStartups.ch and you look at all the different companies there, and each of them have a Series B, valuation of 20 million or something like that? What goes into that calculation?
So I think in venture you would probably use like the two most used valuation methods are relative and comparable valuation methods. So you would probably look at multiples of revenue multiples, EBITDA multiples, less so because most of the businesses are at the stage where they're still EBITDA negative. But you would look at revenue multiples or any kind of other multiple that you think could be comparable to that business that you're looking at. So you would say, I don't know, you look at, let's say for a B2B SaaS business, a subscription business with recurring revenues, you would look at the multiple of the annual recurring revenue. So you would say, I don't know, there's even indices from Bessemer Ventures, for instance, where you have an index that shows you across all software businesses that includes Google, Microsoft, Facebook, Apple, etc. You would look at what is a multiple that they're trading on, these businesses, and then you would say, okay, this is in the B2B SaaS space, and you would apply a multiple on the ARR that the business is generating. So that is a very common. And then of course you can create different peer groups where you say, okay, let's say you have a fintech company, so you would probably look at public listed companies in the banking space. You would probably look at some that do payments. Let's say it's a payment fintech. So Visa, MasterCard. You would look at some banks where they're trading, UBS, I don't know, any of the other banks, Goldman Sachs, JP Morgan, etc. You would look at, and given it's a technology startup, you would also look at some tech companies that are publicly trading. And then you would take somewhat an average across these different peer groups, and you would find the valuation that you think is fair. And you could do some adjustments to it. And I don't want to go to the nitty-gritty stuff of it, but you can do some adjustments for minority shareholdings. You can do for some premiums, etc. So there's some way to adjust the public market comps that you're using for, that you're using for your valuation. But that is how you usually would go about it. The other way is to go about it is that you say, you look at similar businesses or other startups, let's say they're raising in the Series A stage, and you say, okay, independent of the sector, not completely independent, but you could just ignore the sector that they're in, which is not probably wise to do, but you could do it. You could just say, okay, on average, I don't know, Series A businesses in Europe or in Germany or in some geography, because that also, it's often there's a discrepancy between US and Europe. So let's say you look at European Series A startups, they usually raise, I don't know, something between 5 and 20 million in their Series A round, and they get valuations of X, Y, Z, whatever. And then you can also go about this in order to just get a feeling of where, given the stage you are in, what kind of valuation you think is fair for that business. And then there's another way, of course, in startups, which is probably the third one that I missed. It's not only two, but it's three ways to look at valuation. The third one is, of course, often the valuation is just defined by how much does the business need in terms of cash or in terms of funding that the founders or the team would like to raise. I don't know, let's say they're planning, usually you're planning in 18 to 24 months horizons. That's at least in Europe the standard. So founders would always plan for, let's say, I don't know, 1.5 years to 2 years in terms of runway and operational costs, and that is sort of the amount that you would try to raise, because there's a general idea of that you would say every 2 years I'm trying to raise a funding round, because it costs time. It's timely to raise a funding round, so you don't want to spend, and usually they take 6 months, so you don't want to spend you don't want to raise too many rounds, because they're just expensive in terms of cost of your time. They take away focus from the team, etc. So that's why you usually operate in like these 2 years cycles. It's a very general rule of thumb. But let's say you plan on raising that amount, and then you basically say, okay, I'm willing, or the founding team is willing to give up, I don't know, 10%, 20%, maybe 30% of the business. and that in turn gives you then a valuation of the company. So and that is probably more often the case than any of the other two valuation methods, especially in the early stage. If founders say, I want to raise, I don't know, 1 to 5 million, and they're willing to give up, I don't know, 20% of the business, so you're ending up at a valuation between 5 and 25 million, and that is often a negotiation. Let's say funds like us, or other funds could say, usually we invest, I don't know, X amount, and we want Y% in the company for that investment. That is often the approach, and then it's a negotiation between founder and fund, where you will end up after all.
Now, what about when a company which you have invested quite a lot in appears to be failing? They don't want to do well, but you are also not just an investor, you're also helping them. How involved do you get, and what sort of involvement do you have?
Yeah, so that is a very good question. If you have a business where you have, let's say, as you mentioned, quite an exposure, or let's say invested more than, let's say you have a higher concentration from a portfolio perspective, you need to, of course, decide whether, given that it is a large investment, you want to rescue it, right? So you want to save the investment and don't want to let the company go down. So I think what a lot of people do, or what a lot of funds do, is they really start to dedicate a lot of time to these companies. And this is it's interesting because it is a bit of a contradictory, because usually what you should do as a venture fund, you should always double down on your winners, right? You should always, because after all, a venture fund is a portfolio approach, and you need to make your winners really win big, right? As we discussed before with the success rates. So you really need to help these guys that are doing well. You need to put them on steroids. You really need to push them further, right? But of course, as you rightly say, what happens in practice often, that is theory, right? But what happens in practice often is that people start to, and that is a natural human act probably, you try to save where where something is going wrong, right? You try to fix where the problems are, and that is where you spend then most of your time on, and you don't spend time with the good company, because in your mind it says, these companies are doing well, the founders know what to do, they're growing revenues, they're getting new customers on, there's no need for me, they know what to do. But you rather go and you spend your time on the company where they're losing revenues, they're losing customers, the product is broken, I don't know, the software has bugs or whatever it is, or even structural problems, that the team is not right, some people are leaving, whatever it is. So you really go in, and I think it really requires, and after all, it's a question of how active do you want to be. Because the other option is, of course, you just say, okay, you accept the fact, you say, this is a portfolio game. There is some companies that just don't make it, and even though it's a bigger investment, so be it. However, if you're a bit more behind your money, and if you have a bit, I should also probably say, if you have a bit more concentrated portfolio, so not like a portfolio of, I don't know, 50, 60 companies where, some will just not make it to the next round, or will be able to continue. But if you have a portfolio of 15, 20, maybe 25 companies, it's important that, you cannot just let go of some of them that easily. So we would probably go in, and we do that. So we start to pick the ones where there are the issues, and we actually go in and we help them, even more operational. So that means you dedicate more time, you speak on a more regular basis, you discuss the problems that they have at hand, or that they're facing, and you really start to roll your sleeves up, and get into the business. And that's probably goes beyond, let's say, our board seat that we would have, but you really start to get a bit more operational, because obviously something is not right, and you will become, again, it depends a bit on the involvement in the business, but you will become sort of a team member. And you work with the business much closer on the operations and the day-to-day operations.
How does that work when you have multiple venture capital firms invested. So you're one of them. Maybe there's a few other ones as well. Do you create some sort of steering committee, some board with someone from each of them all involved? Like why does Nordic Eye get involved but the other ones don't?
Yeah, it's often it's a mentality question. Often it's the other funds might just say, and I've seen it, like other funds, they might just say, okay, as I just described it before, some investments go wrong, some go right. This is one that goes wrong. I'm okay. I don't want to spend my time on that. And then there's other funds like maybe us that say we don't accept that this is going wrong. We also have other portfolio companies, but we will, we think we can help. We think we know what needs to be done, and we get to work basically. So often it is more a mentality and a question of how proactive you want to be. And what I should probably add here is that usually when companies don't go right or something is wrong, there will be a point where the company needs again funding. I mean, that's usually where problems arise, right? It's never that, or I should not say never, but often it's rarely the case where the company has plenty of cash at the bank, and there, yes, things might go wrong, but it's not life or death, right? But often it is. What is the case is that at some point the company will reach a peak and they won't have any funds available, and then the problems arise because you say, I'm soon out of liquidity. We don't get enough customers. We're not generating sufficient revenues. The cost base is too high. We need to do something. And then the question is, what is that something? And so then often it comes down to, who is still willing to support this business, and that does not only mean operationally, as I just described it, but that also often comes down to who is willing to put more money into the business. So often you get to the point then where you say, yes, we can help, but then often the question is, can you help also with money? And then often you will see, who leaves the room and who stays in the room, and that is often what defines the dynamics between other funds or other investors on the cap table. It doesn't have to be funds necessarily, who will then take a bit more ownership or a bit more stake in the game or in the business.
Mm. I wanted to ask now about insight into trends and sort of the future in startups and the direction and the patterns you're seeing. Are there any specific areas or technologies that you are seeing more and more as trends pop up? I mean, I guess AI is an obvious one because of the last sort of year or so, but is there anything else that really starts out as something that's booming?
Yeah, so with trends, there's so many predictions and emerging trends that you can probably, everybody can read on. I have artificial intelligence is definitely one of them, as you just mentioned. But I think there's often, what is often required is that you look a bit in some of the markets or some industry a bit more specific. And what I've found, in my experience at least, that is often in different sectors, you will find some smaller trends. And that is often what I'm looking for. So if you dive into, or if you double click on one sector or one industry, you often see that in that one industry, which is not that as obvious as artificial intelligence or, I don't know, Bitcoins or blockchain or electric vehicles or something. But if you click one or two layers even below that, you often see there is some trends into some direction. I don't know, customers suddenly start to look for these kind of products, or they look for these kind of services. So that is often what I'm trying to chase. But the larger and broader trends are definitely everything which has to do, as we said, artificial intelligence, a lot in the financial space. So that is blockchain, that is cryptocurrencies. That was a hype. It is still there. It has decreased a bit. There's a lot of things going on in the sustainability space. So everything around environmental stuff, climate tech, sustainable living or consumers, the health problems and these a bit more longer term trends. There's many of them, which I personally also like a lot. But there are some that are sometimes a bit too overhyped and often a bit too general. If someone says, I don't know, artificial intelligence, just to stay with it, is the top trend. Like often you need to really zoom in. What exactly do you mean? Because it applies to so many verticals and so many subsectors that it's often it is a general trend, correct? But what is really where is really the growth happening, and where is really the transformation and the innovation happening? And that is what I think people should look for. But the ones I mentioned are sort of the bigger ones and the more broader emerging ones.
I guess also you have to be careful that you're not just sucked into, if a startup is smart, they'll use whatever trend is popular to market or advertise. Everyone can say that they have AI in their tool if they are using ChatGPT to find some answers. I guess depending on how they use whatever the trend is, probably takes a bit of research and knowledge.
Correct. You always need, as an investor, to really, you need to go in and understand much better what it means. And as you say, with these hype topics, it's a lot of companies have, I can maybe say one example. Like there was one business, and that is probably what, so there was one business that we looked into in the UK. It's in the sustainable consumer space. Basically, in very short, what they're trying to do is they try to increase transparency for consumers on how sustainable a product is. So let's say you shop online, and let's say in the category of beauty products, you want to buy a hand cream or a sun cream or I don't know, whatever other beauty product you want to buy. Often these products, they claim that they are, I don't know, vegan, and they were without child labor, and whatever claims they make, how valid is that claim in fact? And the company, it's actually one of our investments. They have exactly, they were basically worked around that in order to just to show to the consumer or the shopper who's buying the product online that they can verify if these claims are actually facts or if they're not. And in order to prove these or to have evidence for these claims, for these beauty products, they were using, or they are using, blockchain technology in the back. And I remember once when we got to know them and when they pitched us, they really talked about how important it is to have the transparency. Consumers are looking for it. Of course, they also mentioned that for the shops, it increases basket sizes, retention, traffic on the websites, etc. But there was, in the end of the pitch deck, there was one slide where they said, and by the way we are providing the evidence, and where we are making sure that everybody can see the same evidence, and it's not something a black box that we just hold internally into our company, is that we're using blockchain technology. And that is exactly to the point, as you say, when we talk about these hype and trend stuff, is that these are sort of the businesses that I would say is worth investing in, because they have understood that this is not a buzzword that will attract investment, but they are just using the technology operationally to be efficient, or whatever it is, to decrease costs, to have more transparency, for whatever reason you want to use the technology, instead of putting it on every slide on the header saying we are a blockchain business. And at that time everybody was trying to invest into blockchain businesses. So that is sort of the companies that you need to look for as an investor, where you say they're not raising money on on the hype of being an AI business, but rather they're using the technology in a very smart way. They're solving a problem, but we're using AI to do it. That is what I think you should look for.
Yeah, coming from a management consulting background, I am very familiar with pitch decks with empty promises of current trends. That's for sure.
There you go.
Yeah. What about, given Nordic Eye has offices in a few different countries, how is Zurich positioned compared to other cities in Switzerland, or more importantly, Europe, I think, in terms of as a place to get started with a startup?
Okay, so from a startup perspective, I think as I think we talked at the beginning of when we talked about sourcing investment opportunities, I think getting started in Zurich or in Switzerland per se is definitely a good place. You have, I think the infrastructure is good. You have talent. You have, good educated people. You have good university, as we mentioned with ETH, especially on the tech side. And you have, of course, access to capital, I would say. It's not that easy. It's not that straightforward, but there is probably, I don't know the statistics exactly from the other hubs in Germany, France, Spain, etc. But there is probably a higher probability of getting, or a high probability of getting funding if you have the right network and the right people here in Switzerland, just because it's a wealthy country and it's a wealthy city. I think the other part, of course, or the challenges, of course, that you have, that the Swiss market, if your product or your service is for the Swiss market only, it's a bit of a limited and smaller market. So you would have to start here, of course, have, first pilot customers in Switzerland, but then if possible and if the operations allow it, expand to other regions. And the first, let's say the easiest way to go is, of course, to Germany or to Austria, given the language, maybe Austria, but Germany as a big economy as well. And expand to these markets, because the Swiss market is definitely a market that you can start with, but there's often the argument that you can only reach a certain, until you can only go into a certain level. So you would have to, you would have to have the thought of expansion and going into another market, and that is operationally, it's not easy, because that means opening another office. Maybe means opening a German entity. I'm just taking Germany as an example, but operationally you need to have the funds, but also the willingness and the power to expand very quickly, because if you are, let's say, if you compare to a startup in Germany, you could probably just sit wherever you sit and serve the German market, and then you probably can get to a very good level.
Okay, we're out of time, so I have one last question for you. What advice do you give to entrepreneurs or young startups looking to attract venture capital investments? What are some lessons learned that you can pass on so they don't have to make some mistakes?
That's a very good question. I would start by saying the following. Not every business needs venture capital or outside funding. I often, and I'm saying that because probably, when I speak to people, it's always about, I'm just going to get funding outside from a fund or from business angels or whatever. But there is also some businesses, and of course you need to be lucky, you need to know your market, and you need to have maybe also your own means to finance it. But there is also ways where you don't need actually external funding. So I would suggest to the listeners also to, if you want to start a business or you have a business idea, you can also, we call it bootstrapping. You can also bootstrap it to a very good level. And that comes with a lot of benefits as well. It's not easy, and it takes probably longer. Outside money is always easier, because you can spend that money from day one, which you wouldn't have otherwise. But before starting and going out fundraising and asking people for money, giving up shares in your business, etc., also think about the opportunity of bootstrapping your business with your own means that you have available, with with friends. Instead of paying salaries, you start to partner up with your friends, with colleagues, whoever fits into the model, and start the business from there. And then you can later on, of course, if you think, okay, now we've hit sort of a certain threshold, or now we want to go for this way, and that we really cannot afford out of our own cash situation or liquidity situation, we need someone else to fund this, I don't know, big expansion or this big product release or whatever. Then of course you can always go and find outside funding. But don't forget the point that you can always start also, without external funding. I think that's the point that I'm trying to get to. Of course, then if you nevertheless, it's of course valid to raise external funds, to get it from friends and families and individuals, and later on also from funds or professional investors. I think the important part is that you always need to act in a way that you are aware that you're always, someone else has given you money in trusting you, in having faith in you, and having probably giving you money because they see an opportunity in you. And that respect or that understanding needs to be both ways. So it's important that someone that is raising money from someone else is aware of the fact that you are, in the end, you're responsible. You have a responsibility towards the investor, You have a, it's just a partnership where, of course, he's not working with you day in and day out, but he has at least some stake in the business, and that is always important to keep in mind.
And from a networking perspective, how do they get noticed? How do they bump into you at a party?
Yeah, so I think, as a owner, as a founder, and as a CEO of a startup, you always need to pitch. I think that's one of the core rules that I always hear the guys. I've never really started the business myself, like as a startup, but you probably will always pitch your idea, because people will naturally ask you when you get to know someone, what do you do for a living? What is your work? What is your profession? And then you will always explain them, look, I'm building this, I'm doing this startup, we're building that service or whatever it is. So we naturally always start to pitch people, and then you will find people. It's often a mouth to mouth connection. A lot of people are well connected. So it's really about that you always pitch your idea, you always share your story, you always share your plans, and that's how you get to the right people often. Especially in Zurich, and that's probably one of the facts that I missed before, that the reason that Zurich, I'm now talking Zurich because we're both based here, but in Switzerland in general, I think in the bigger cities, the community or the cities are not that big, and that is really good for getting to know people fairly easy through 2 or 3 maximum connections. And that can help a lot, because that person knows that person, and that knows that one, and then you're already there. It's someone that you would need to speak to. So that is a big positive actually for Zurich as a location to start a business, that the networking is fairly easy to do. And so is the same for fundraising. You can get to know your next investor probably through 2 or 3 connections, I guess.
Mm. Well, thanks, Philipp. Was there anything else that I've missed that's probably worth mentioning?
No, I think we covered it all. It was very exhaustive, but I'm always available to reach, and and available for conversations or networking as we left it.
Cool. Well, thank you very much for your time, and I'll speak to you later, hopefully.
Perfect. Thank you so much, Mike.